Good afternoon and welcome to today's webinar, Shadows or Sunshine, 2023 Year in Review and a 2024 Investment Strategy Guide. Our esteemed speakers, Krista, Kerr, and Frank Settino, will delve into the latest market updates, focusing on the implications of current market conditions and geopolitical trends. They'll also consider the age-old question, will the groundhog see its shadow and retreat, giving us more wintry weather and challenging markets, or will there be no shadow this year and an early spring? We can always hope for the early spring. We will then conclude with a dedicated Q&A session. Before we dive in, a quick note again, there's a Q&A icon you will see at the bottom of your screen. Should any questions arise during the presentation, please use this feature to submit them. We'll gather all of your inquiries and we will address them with our panelists at the end in a Q&A session. So just a little bit about Kerr before we begin. At Kerr, our primary commitment as investment managers is as a discretionary portfolio manager, and that's our fiduciary duty to our clients. We champion a disciplined, long-term approach to wealth creation and preservation. Our philosophy really emphasizes the significance of diversification across all asset types, regions, and sectors. And furthermore, we prioritize a multi-manager portfolio, handpicking top-tier investment managers from around the world with a range of styles to ensure the best outcomes. Allow me to introduce Krista Kerr, our first speaker. She's the esteemed CEO of Kerr Financial Group, one of the leading wealth management firms in Canada. Under her leadership, the firm excels in providing top-tier investment management services backed by strategic insights that cater to individuals, business leaders, and affluent families. She leads the firm's investment committee, and she ensures that our clients benefit from the most informed investment decisions. Additionally, she helms the firm's multi-family office division, focusing on multi-generational wealth stewardship for our ultra-high net worth families. Outside of her core responsibility, she's recognized authority in Canadian personal finance, often sharing her investment and financial expertise across various media. She dedicates her time, in addition to the arts community, serving on boards like the National Ballet of Canada and the Festival des Arts de Saint-Sauveur, where she contributes to their audit and finance committees. Next up, we have Frank Settino, and he's the driving force behind our Montreal Investment Management Services. He has a solid foundation built from many years managing portfolios and a very deep understanding of the investment landscape. Frank is adept at helping clients achieve their investment goals. His 2-decade journey began at Tal Investment Counsel, where he managed both accounting and administration functions and diverse portfolios. Over the past 15 years, Frank has been instrumental in guiding portfolio managers in security selection, serving as vice president of Canadian equities at a major Canadian financial institution. His collaboration with our financial and tax experts here at Kerr Financial really ensures that our clients receive comprehensive, holistic, analytical approach to their investment management. Frank is a chartered financial analyst as well as an alumnus from the prestigious John Molson School of Business. I'd like to ask Krista to turn on her video and microphone, and she's going to begin the next piece of our presentation.
Thank you, Kathleen, and good afternoon, everybody. This is a pleasure to connect with you early in the new year. I hope your new year is starting well. It's an interesting time for us because the beginning of the year always is a time where many analysts come out with their outlook for the year. And one of the things we're finding this year is that there's a big variation, a big variance in what people are expecting. So you see quite a bit of difference in the outlooks. And what we're going to hopefully do today is cut through some of that noise, look at sort of what the data is telling us, what happened in 2023 briefly, what do we expect in 2024, what are the risks that we see, and then all of that pulling together in terms of how we want to position portfolios. So that's what I'm going to cover, and then Frank will be talking about some specific markets as well. But just before we get into the meat of that, we want to, as is customary, ask you a little bit of information. And this, I think a lot of people are talking about landings this time of year. So I'm curious from your point of view, we'll talk about our point of view, but given what you expect around economic growth for this year, unemployment and inflation, do you anticipate that 2024 will bring a soft landing, meaning that the Fed will pull off the what people didn't always think was possible, a slowing growth, but no recession? Or do you think it'll be a hard landing where this delayed impact of higher rates is going to cause abrupt decline in economic growth and therefore definite recession? Or somewhere in between the two, a soft-ish landing, some people are talking about, which means slowing growth with a technical recession, but not one that's deep or long? Or no landing, you know, the most optimistic outlook that the economy is going to continue to grow in spite of the monetary policy contractions we've seen. So just curious about the pulse of the audience, if you can let us know what you think in these options. Aha. I tend to agree with you. I think it's interesting. We have a combination of some people feeling that we're going to see a soft landing, and I think that's even potentially more likely in the U.S., where they've got a little bit more strength in the economy, or a softish landing, which is really what we're likely to see in some of the other economies. You know, you think of some places that are suffering a bit more, like UK and Germany and even Canada. You know, we will maybe likely dip into technical recession. The Royal Bank is saying there's 70% chance of maybe going into a technical recession, but they don't think it's going to be long and deep. So I think there's definitely a lot of support for both number 3 and number 1, which is where people are sitting, and not so many on the extreme. So I think we tend to agree with you on that. Thank you. So we're going to start looking a little bit at the highlights for last year. Now, this always seems like it's a little bit of a look back in the mirror, but I think it's interesting when you think about the year as a whole. You know, early in 2023, when we started, the market really expected we were going to see growth decline and a high likelihood of recession in 2023. So expectations were quite pessimistic or cautious at the beginning of 2023. And there were a lot of reasons for caution. If you look at, you know, that list of headwinds that we faced, you know, we had the largest increase in interest rate in decades, with the Fed rate exceeding 5%, which was a really, you know, a big, fast increase in rates through that period. We saw, sadly, multiple international conflicts between the continuation of the situation in Ukraine and also the Israel-Hamas conflict. So that's still an area to watch out for. There was an energy crisis, or potential energy crisis, in the EU. I think we were lucky that last year's winter was not so tough, but there was a concern because of Russia's supply of energy to the EU that could cause an energy crisis. I think things have stabilized for now, but that's still something that we need to watch as we look at weather and stability of power plants. And then, I don't know if people remember, it was a big deal at the time, but we had the regional banking crisis, especially in the US, those sort of regional banks. Now, I think some of those were idiosyncratic to the banks that were financing sort of tech VC startups, but we definitely had that in the mix in 2023. And we started to see a little bit of a trend towards some deterioration in credit and auto loans, et cetera. I think back to sort of more normal rates, but the trend was deteriorating a little bit. So all of that were some pretty serious headwinds that faced us in a time when we anticipated things to be difficult. But if we look at the right-hand side here, we had a number of factors that really helped to stabilize growth. So especially in the US. So the US consumer remained very strong, and that was still having a strong amount of cash on the balance sheet. And especially in the US, where people tend to have very long, 30-year mortgages, et cetera, the increase in rates doesn't hit for a while because there are very long, extended fixed terms to people's borrowing. So the consumer stayed very strong, and that was a real driver of the economy continuing to do better than people expected. The job market continued to be strong. We also saw quite a bit of fiscal stimulus, both in the US and Europe. Oh, if you can go back just for a second, Kathleen. Oh, there we go. Yeah, so I think all of those things made things a little bit stronger. And because of all of that, we avoided a recession. We didn't have a recession in 2023, and risk markets really finished the year very positive. So that's just sort of a big picture look at 2023. The next slide talks a little bit about Q4, the fourth quarter. So you may remember, again, as we go through when we were talking about the third quarter, we had July being positive in the third quarter, but August, September being difficult. October continued to be difficult. And really throughout the year, we saw some sell-offs and rallies as people changed their minds about where we were in terms of inflation and when interest rates would start to drop. So we had lots of back and forth. October was continued to be a difficult month, but at that point, we started seeing some positive signs in terms of inflation. So job growth was moderating, wages started coming off a little bit. So even though unemployment remained low, we still had some wage growth dropping a little bit. And all of that led to some softer inflation numbers. And that helped to central banks to believe that they could be closer to the end of the rate hike cycle, and that rates may have peaked and might see something positive going forward. So I think investors really became convinced in November and December that central banks will start to cut rates in 2024. And so for the quarter, because of that strong performance in sentiment in November and December, we really had positive returns in all asset classes and a positive finish for balanced portfolios. Before we talk about, we'll look at some numbers on some graphs, but I wanted to just highlight fixed income. So fixed income had a really difficult first 3 quarters of the year. We were looking negative for bond returns for the year to date to the end of September. But in the fourth quarter, again, with those expectations that rates could start coming down, bond markets started having quite a positive rebound or recovery in the fourth quarter in November and December. And we've now moved to positive fixed income returns for the year because of the positive returns in the fourth quarter. In the first 3 quarters of the year, because of the shape of the yield curve, the inversion levels, really it was shorter duration bonds that did a lot better than long ones. In the fourth quarter, yields started coming down across the board, so that favored longer duration bonds a little bit more. And the corporate bond market also did see some recovery, again, with lower expectations of recession, et cetera. So fixed income overall looked positive. So if we look at the next slide, we're going to see a graph of markets, and the yellow bars are the numbers for the fourth quarter itself for October, November, December. The deeper blue bars are the 1 year. The gray bars are 3 years, and the softer blue is 5 years. So if we look, one of the things we'll see is that the yellow bars, the fourth quarter bars, are all positive. So as we talked about, we've still got a positive return in cash. So, you look at cash over the 5-year average was only giving us just under 2% return to portfolios, but in 2023 actually gave an average of 4.7%. And in keeping with that was up 1.3% for the quarter. The bond market is where you'll see what I was just talking about. We ended the year up 6.7% in the Canadian bond universe, but that was really all driven by the fourth quarter being up 8.3%. So that recovery in the fourth quarter helped to lead to positive returns. That fourth quarter number somewhat in keeping with equity market returns. On the Canadian side, well, Canadian, US, and international, you can see the fourth quarter yellow bars were all positive, and you can see that it contributes to a positive return in all equity markets for the year. You'll see that big outlier of 23% return in Canadian dollars on the US market, the S&P 500. And as we'll mention in a few minutes, that's really driven a lot by those magnificent 7 stocks that were up, the very large mega cap tech stocks that were up collectively about 111% last year. But equity markets positive for the quarter, including emerging markets, which were up 5.3%. And all of those returns contributed to a balanced portfolio return of about 7.9% in the quarter and 11.3% for the year. So much better than our 2022 results. And in many cases, erasing the difficulty of 2022 in portfolios. So it was a positive return. Specifically with respect to equities, you can see, we talked about it a minute ago, that the S&P 500 was up almost 23% in Canadian dollars. And as I mentioned, that was largely driven by the Magnificent Seven, they're calling them. So that would be Apple, Microsoft, NVIDIA, Alphabet, Amazon, Meta, and Tesla. Those companies collectively were up almost 111% for the year. And that's a result of many things. There was the expectation of AI providing greater growth in that sector. There are strong balance sheets in those companies, and also their long duration, returns that are going to come over a long period. So as interest rates come down, that helps them too. So there were a lot of reasons for those stocks to do well. One thing we did note in the fourth quarter, though, is that we saw a broadening of markets. It wasn't only the tech stocks that were up in the fourth quarter. We actually saw all sectors except for energy be positive, and some of the ones that were interest sensitive that had been down before, with the expectation that rates would come off in 2024, started to see some positive returns. So we had a broadening of returns by sectors and similarly by styles. All styles contributed to equity returns, even though quality growth continues to be the biggest driver for the year. And we'll see those two things play out on the next two slides. So this one, you can see sector returns. And again, the pale blue, the first bar, the pale blue in this case, which is the fourth quarter returns, are positive everywhere except for energy, which was down 6.9%. But all other sectors were positive. Still very positive in technology, but also you can see something like real estate, which is very interest rate sensitive, coming back fairly strongly in the quarter because of expectation of rates coming down. So broader sector participation in the fourth quarter, and then over the year, still that big impetus from the Magnificent Seven stocks. That this is U.S. sectors, so you see them in the technology and communication sectors. And the next slide just sort of shows the same thing with style. So over the year, the quality growth style is really protective, where you can see for the quarter, all styles really contributed. So even the sort of value stocks were quite positive too. So we saw a broadening of where returns come from, and still some focus from the quality growth factors. So where does that leave us as we enter 2024? I think that's the most important question, I guess. And sort of to the poll that you guys started with, I think a soft landing remains possible. So we still see some positive factors in there, in that inflation is continuing to normalize. In terms of housing or shelter inflation, we're seeing easing rental rates in the US. That is helping that be a bit of a driver of a deceleration of inflation. We're also seeing the labor market rebalancing. So I think companies are realizing, it was very hard to get talent through the pandemic. And so people are resisting letting go of all their good staff, but the wage growth is softening. So there is some rebalancing happening in the labor market. All of that is helping inflation to continue to normalize. We also are seeing some expectations of slowing growth, but still positive growth in the markets. We still see the US consumer being very strong, and a gradual easing of interest rates or financial conditions that will help that. Business investment by companies is holding up, and there's still quite positive expectations for earnings per share growth in 2024. So a soft landing is still possible. But when you look at expectations, now the expectations for recession are really all over the place. This is a chart that came out of Goldman Sachs. Oh, if you can go back to that, Kathleen. The bottom over here on the right, the investment strategy group at Goldman Sachs is looking at, that they were thinking in 2023 that the probability of a recession was 45 to 55%. They've now dropped that down to 30%, but 30% continues to be higher than the 13 to 18 sort of longer term expectations for recession in any single year. So still an elevated chance of recession. And in fact, some people, like I mentioned, the Royal Bank came out with their numbers in January saying they have a 70% expectation of recession at some point in the year in Canada. So this is going to be a region specific, but also, specific to the analysts. But I think the idea is that we think a soft landing is still possible, but we've still got to keep in mind some of the risks that may lead to recession and make sure we manage those. These are reinforcing some of those comments. So inflation is moving in the right direction. And you can see this is towards the end of, coming to the end of 2023. You can see energy being the green bars being one of them, where they were contributing a lot to inflation in 2022. And then their reduced prices were leading to a deceleration of inflation in 2023. Similarly, shelter, which is the dark blue bars, are starting to come off in the far right graph there. So things are moving in the right direction. We have to remember this isn't going to be a straight line, though. You saw in Canada, there was expectations that December core inflation was going to be a little bit lower than it ended up. So we're going to have probably some ups and downs in our expectations, but overall things are moving in the right direction. And the next graph's also from this one's from Goldman. The previous one was JP Morgan, but you can see here again, the expectations are that inflation is going to move down towards the 2% target rates into the future. Whether that happens right at the end of 2024 or into 2025, we're seeing things move in the right direction. Again, it may not be a linear, very smooth drop all the way through, and we have to keep an eye on inflation, specifically labor markets, I would think. But things are moving in the right direction overall, and central banks will be looking at that direction, and they'll also be looking at how sustainable that reduced inflation level will be, because they don't want to see inflation just touch down at 2% and go back up. They want to see that it's going to stay there for a while. Also, sort of similar to what we said before, there is reason to think we're going to see a gradual easing in rates. So at the end of last year, we had the Fed funds rate in the US over 5%, which is really a very high level, the highest since 2007, when we had a little bit of a higher than 5% as well. And the members of the committee, the FOMC, who are coming up with their views on what's going to happen with US interest rates, the consensus really is that rates are moving in the right direction. There's some difference of opinion as to the pace at which the rate cuts will happen and the timing of when they're going to happen, but the consensus is that they will come off a little bit. It's interesting when you look at fixed income markets or bond markets, they're really pricing in rates dropping to maybe 3.2% by the end of 2024 and potentially up to 6 rate cuts starting in the spring. That may be overly optimistic, I would think. We're saying here we are seeing rates come down in the right direction, but whether they get to that 3.2% by the end of 2024 and whether it's in 6 cuts may be up for debate. I think our viewpoint is that we're likely to see the cuts happen in the second half of the year, and to be aware that we think the Federal Reserve will be very disciplined and measured in the pace at which they cut rates. They had very big increases in rates leading up to this, some of them 75 basis points, but I think on the way down, they're going to be measured and careful and really paying attention to the data before they make those moves, because I think they really do not want to cut rates and have to reverse course. So everything is moving in the right direction to get rates down, but it may take a little bit longer to get there, to get down to sort of a 2% rate. And we don't think we're going to be down at 0 again in the foreseeable future. That was sort of an unusual period, but they are moving in the right direction, which is positive. One thing we need to be aware of, though, as we look at all of that, is there are still a number of risks to the outlooks. And that's where you see some variation in where people's outlook expectation is. I think one of the risks to the tailwinds, I guess, is that pace at which central banks are going to approach the rate cuts. So if cuts happen a little bit more slowly than the market, that could create some risk to the tailwind that's expected. But then there are a number of risks that are laid out here. So economic strength is uneven across the globe. You can see US, India, and the emerging markets largely because of India being strong, and UK, Germany, China, and maybe Canada being a little bit less strong. So we have less, it's not an even participation in economic strength. We are seeing some of those signs of credit stress, partly here. I mean, I think there is an increased sense of delinquencies in auto loans and credit cards. It's not a remarkable one, though. It's sort of in line with long-term trends, but that trend to have a little bit more delinquencies is one that we want to keep an eye on and watch. I think all of us are aware of significant geopolitical risks and whether some of the regional conflicts that we have will become worse and spread. That's something we need to really pay attention to. We also need to pay attention to the increasingly strained relationships between China and the US, or China and the West, really, as we look at it. There's a lot of national elections coming up this year. The one that we're probably all focused on are the US elections, because we see a lot of it in the news. When you look at elections, they don't always really matter in the long term in terms of returns, but generally speaking, a year leading up to an election hasn't been negative for markets, because both parties will try and keep as much positive economic backdrop as they can. People will be watching, who gets in power, to think about what will spending look like going forward, what will taxation look like going forward, what will those mean for the markets. But I don't think the outcome is a huge driver of the markets itself. The issue will be the gridlock you could see in the US, around the debt ceiling, et cetera. Will the parties be able to make decisions together? And then just recognizing that a lot of countries are going to the election polls this year, and that could create volatility and uncertainty in various places. So that's something we need to keep an eye on. Debt ceiling, somehow the US seems to think that even though the debt amounts are rising quite a lot, that we're going to muddle through and it will be okay. But we keep being pushed right to the end before decisions to see if the Congress can make decisions together, and that can continue to provide a bit of volatility. We also need to keep an eye out for climate events and whether that interrupts any of our food supply chains. And then, of course, cyber attacks and terrorism, which could continue to be issues that we face as we get towards an election year, et cetera. So this is probably a bit of a scary slide, but I think that the key is that we saw in the previous slides that some things are moving in the right direction. We've got inflation moving in the right direction. We're likely to see monetary policy become more accommodative. Things are still looking okay with business investment and with the US consumer. So those are all positive backdrops, but risks do remain. So we're likely to continue to see some volatility in returns. And we also need to be diversified and defensive to take care of the fact that we may see some of these risks. So all of that gets us to the question of what does this mean for markets for the year? And I think, we talked about what that meant for the economy through those previous slides. But I think with markets, the other thing we need to think about is valuation. So the fourth quarter, particularly November and December, saw very high returns, very high increases in risk assets in those 2 months. And as I mentioned, a lot of optimism that we're going to see rates come off to 3.2%, and we're going to see 6 cuts in interest rates through the year, maybe starting as early as March. That may be optimistic, and so we therefore wouldn't be surprised if we do see some sell-offs and some continued volatility. And building on that same point, we could see some tailwind risk or a few headwinds if the central banks are slower and more gradual in their rate cuts, or if inflation comes back faster or more than we think. Inflation won't come down, as we mentioned, in a straight line, and that could have some issues for markets and valuations. So I think on balance, we're likely expecting that we might see mid-single digit returns for balanced portfolios, sort of in the 5 to 7% range, not the 11% like we saw in 2023. And we do expect that things may be more volatile because we're going to continue to see economic data and inflation data coming out, and people will have changes in their expectations about interest rate cuts and timing. So that's going to lead to some volatility. I think in terms of returns, we're likely to see that broadening that we did see in 2023 at the end of the year, where the returns were not only coming from the large tech stocks, but they were also coming from other sectors. So we anticipate that there's some opportunity in some of those sort of more value-oriented names that didn't come up as much in 2023. Not saying we don't want to be in the others, but we think we can have a broadening there. So all of that tells us when we're looking at portfolios that we really want to embrace diversification. So we want to have diversification across various sectors because we think the returns are going to broaden out. We also want to have some variation or diversification in geography in terms of, not only having US holdings in the portfolio, but also having Canadian and international names. And Frank's going to talk a little bit more about expectations for the US and emerging markets later on. And I didn't write it there, but we also want to have that diversification in asset classes because, we think there's some benefit in having cash for some short-term needs, but to the third point there, because yields are becoming attractive, it's also a time to maybe lock in some fixed income returns as we expect cash rates may come down later in the year, and having some bonds will be a protection against that possibility that a recession could arise. So we want to have asset class diversification, sector and geographic diversification. We always look to those, but especially in a year like this where we may see volatility. We still like to have different factors, different style. We look to managers that we combine managers in portfolios that have different styles, but we really like that focus on quality right now. So that would be companies with strong balance sheets, good management, durable business models, and advantages that will help them. Those are the companies that are going to see some premiums to their valuation, and they're also going to hold their own if things do slow down. And then the yields we talked about, there might be some reason to reduce the cash weights a little bit and have some fixed income in there as a hedge against recession, but also to lock in those rates. With volatility in markets, we think active management can be helpful as opposed to just owning the indices. We want to continue to focus on the long term. So make sure that we're really invested in your portfolios alongside your long-term targets and strategies, because we might see some volatility and we don't want to be shaken from the long-term plan. And then because of those risks that exist that we talked about, we're going to be remaining very vigilant, looking at markets, talking to the managers, making sure that we keep an eye on those risks and whether we need to make any changes, but also vigilant for opportunities as they may arise. Thank you.
Thanks, Krista. Thanks for that excellent market update. We're going to move on with another question, a polling question for you to consider. So I'm just going to launch that, and then I'm going to ask, while we're doing this, I'm going to ask also Frank to turn on his recording while we get going. So I'm just going to launch our second polling question here. So there we go. So you should be able to see the second polling question. So I'll just read it out for you. So which equity market do you expect will generate the strongest returns in the next decade? US equities, developed international equities, Canadian equities, emerging markets, or are you unsure at this time? So I can see you're answering it. I'll give you a little extra time to fill in your answers, and then I think Frank will have something to say both about your answers and about his thoughts related to this as we move forward. So I'm going to end the poll now. And so I'm going to share the results with everybody here. So reading them out. So on the recording, you can see them. The U.S. equities seems to be the winner with 58%, thinking that will be the strongest. Emerging markets are coming in number 2, but a little bit behind at 18%. A few of you are unsure at 18%, and then developed international equities got a bit of support. So I'll stop sharing and I'll be turning this over to Frank, who's going to walk you through his portion of the presentation.
Well, those were interesting polling responses. I'm not surprised by the favorable view for U.S. markets, and obviously, hopefully, I'll touch upon, I guess, some interesting tidbits for U.S. markets and also emerging markets that gained a lot of the responses in that polling question. So we have 2 topics for you today. Both may not be totally significant in the very short term, however, we believe are fairly worthy consideration for long-term investors. Working with the theme of the webinar, we'll touch on the asset classes that has attracted all the sunshine recently and analyzing the future return prospects for the U.S. equity market. As Krista highlighted, U.S. stocks delivered impressive results in 2023, but more importantly, the asset class has generated stellar returns for investors over the last decade. We'll highlight a recent research paper that dissects the sources of those strong returns, but more importantly, explores what needs to happen for a repeat of the same returns in the future. For our second topic, we'll drift into a more darker and drearier place for investors. Emerging equity markets have frustrated investors with fairly lackluster returns over the last decade, packaged with a fairly healthy share of volatility. Rising geopolitical tensions have certainly caused risk premiums to increase for emerging markets, and we'll try to highlight whether premiums have risen enough for investors to start paying attention. So let's jump into our first topic on the remarkable returns that the U.S. equity market has delivered and whether we should expect the same type of returns in the upcoming decade. So we came across a fairly interesting paper recently published by AQR, Capital Management, that provides some fascinating insights. So the first insight is how exceptional returns for the U.S. equity market has been over the last decade. So what AQR did is they looked at returns for various asset classes in excess of the return on U.S. Treasury bills. And for the S&P 500, it averaged a 11.9% return in excess of the return of cash for the 10-year period ended June 30th. These returns ranked 90th percentile on a rolling 10-year performance basis across global developed equity markets dating back to 1950. Therefore, relative to history, the U.S. stocks have delivered exceptional returns. In addition, although the returns did come with volatility, notably with drawdowns that we saw in 2020 and also in 2022, on a risk-adjusted basis, the returns were even more impressive. So when you look at this table here that comes directly from the report, it details the return of the various asset classes, the volatility experienced during that 10-year period, and the Sharpe ratio, which is a measure to calculate risk-adjusted returns. Therefore, to underline how impressive the returns have been for U.S. equities, on a risk-adjusted basis, the S&P had a 0.82 Sharpe ratio, which is more than 2 times the risk-adjusted return of non-U.S. equity markets and well above that of a 60-40 portfolio. So the second question the research paper tackles is what were the drivers for the strong performance? And secondly, what needs to happen for the next 10 years for similar returns to occur? So this chart from the report decomposes the excess return for the S&P over the last decade, as well as providing historical attribution since 1950. That's on the right side. The first observation is that the excess return from the S&P 500 was nearly 5% higher in the last decade relative to the average since 1950. However, when you look into the details, there are really 4 components that drive the excess returns. There's a dividend yield, that's in dark blue, that contributed 2.1%, which was lower than what has been the historical contribution from the dividend yield. Then there was strong contributions from earnings growth at 4.5%, which is in the lighter blue. That's well above the historical level of 2.6%. This is a function of the really strong earnings growth that we saw from many of the technology giants over the last decade, namely Microsoft, Apple, and Amazon. The S&P also benefited from a 3.6% boost from multiple expansion. So that's nearly double the contribution the S&P has gained from expanding valuations historically. And lastly, in green, since central banks kept interest rates below inflation for nearly a decade, there was 1.7% of excess return derived from negative real returns on cash. So for investors, it's important to understand the sources of past returns, but far more practical to kind of appreciate what the future may hold when allocating capital. And this is what the final observation of the report addresses. What contributions are required from the four drivers to generate an excess return to match the return that we saw in the last decade, and what has been the historical return for the asset class? This chart decomposes what will be required for U.S. equities to generate that 11.9% excess return, and the 7.1% return is generated historically. So on two of the factors, we've got a pretty good handle. We have a very good visibility on the future contribution from the dividend yield, from observing the current yield on the S&P 500, which is 1.5%. The same goes for the real cash return. While this was a contributing factor last decade, currently the guidance from the Federal Reserve is indicating that the medium estimate of the funds rate will be a 0.5% tailwind. So based on these assumptions, it implies that earnings growth and multiple expansion we need to contribute 10.9% to match the returns of the last decade. Recall that combined, both earnings growth and multiple expansion performed very well relative to history in the last decade and only contributed 8%. Therefore, expecting it to be closer to 11% in the coming decade might be improbable. The next chart captures what's required both from an earnings growth and also a multiple expansion perspective for that 11.9% return. So if we assume that U.S. equities enjoy another great decade of earnings growth as companies reap the benefits of AI, tech innovation, and other positive tailwinds, and earnings growth contributes 4.5%, there would still need to be an 80% increase in the cyclically adjusted earnings multiple from the current level of 30 to 55 to generate that 11.9% return. Therefore, this is certainly possible, but if history provides us with any guidance, it's likely not a probable scenario. So similarly to achieving the historical 7.1% excess return, assuming 4.5% contribution from earnings growth, you would still need multiples to expand by 15% from 30 to 35. So in reading their paper, I guess the conclusions we draw is that there's probably a low probability that the S&P 500 generates a similar level of excess return in the next decade. It does not mean that investors should be avoiding U.S. equities. It simply means that investors should concentrate their portfolios, should not be concentrating their portfolios to this one asset class, and should also kind of, look at returns, not historically, but take into consideration that the last decade might not repeat itself. I think investing in U.S. equities presents investors with excellent exposure to innovative companies backed by talented management teams and a network of resources from Wall Street to Silicon Valley. But I mean, having a diversified portfolio in this context is probably key. So that is a review of our, I guess, where the sunshine is, which brings us our discussion to from the hottest market to the coldest market from a return perspective. So whereas the U.S. market has kind of delivered stellar returns, for those investors that have allocated to emerging markets and countries like China, the returns have been quite disappointing. We know a year ago, many strategists were forecasting for a strong rebound in China, in Chinese equities, and as they moved out of the pandemic lockdowns. But unfortunately, in fact, China had a difficult year. The MSCI China index actually was one of the few markets that fell in value in 2023 with an 11% drawdown. So in the next slide, we try to kind of frame the factors that we believe have caused emerging markets to perform so poorly over the last few years. The first factor is that, frankly, from a geopolitical perspective, we have transitioned from a period with great collaboration between nations that's helped spur the growth benefits from globalization to a period with a lot of friction. This ranges from wars raging in China and in Russia and Ukraine to the growing hostility in the Middle East. We've also seen a meaningful uptick in risk aversion in China, as investors have grown, I would say, reluctant to invest in a country where there's growing signs of potential conflict with Taiwan, but also driven by political actions from the ruling party that's undermined investor property rights. And we saw evidence of this during the summer of 2021, when the Chinese government issued policies to deter further expansion of certain technology sectors in the country. Investors are simply discouraged from allocating capital whenever there are unknown factors. Risk premiums typically rise, causing valuations to fall. And I think that's what we've seen. The second factor is that although economic growth in emerging markets has been very positive, it has decelerated, predominantly in China, where economic growth was expanding at double-digit rates a decade ago, and now, it's still positive, but it's still in the single-digit range. Thirdly, it's really commodity prices. Over the last decade, we've seen prices kind of trend lower, and certainly we were not really benefiting from the bull market of the early 2000s, where investors could reap the benefits by investing in commodity-rich countries like Russia and Brazil, which has also dampened interest in emerging markets. Lastly, all these factors have caused investors to kind of wane in terms of interest in allocating to this asset class. The next slide illustrates the situation as it pertains to China, where net investment flows have been negative over the last 2 years. The lack of interest has certainly dampened valuations across many emerging financial markets. Now, some investors may be looking at this opportunity of investing in emerging markets and asking, why bother when you consider all these factors that we've outlined, with the knowledge of having so many great companies in North America and other developed markets? Well, we think there are 2 reasons longer-term investors should consider an allocation to emerging markets, and also a couple of caveats that we think tie into our constructive view. First, we believe that exposure to emerging markets does provide investors with a large and growing working population that are transitioning to the middle class. So this is definitely not a new phenomenon for emerging markets, but it's, I think, becoming far more apparent relative to developed countries in Europe and Asia, where consumption tailwinds are now fading with aging populations. Higher economic growth does not guarantee better investment opportunities, but we believe that it does provide for a fertile environment for innovation and enterprises to flourish. As we highlighted in our webinar last fall, India in particular has fairly attractive attributes, with a young population with a median age of only 28 years old, which is actually a full decade younger than the population in the US. The urban population is estimated to continue to grow well into the next decade, with a quarter of India's population set to enter the workforce. While we believe companies like Apple and Nestle and Microsoft will benefit from their presence in a lot of these emerging markets, we believe that investors can gain greater exposure to growth tailwinds by investing directly in domestic companies that will become household names in India, Mexico, and Indonesia in the future. The second reason is really a function of valuation. So when you look at valuation, and we highlighted this in the webinar in July, valuation is typically a poor predictor in the short term, but however, when you look at it on a long-term basis, it's proven to be a very good barometer for investors. And this table highlights the cyclically adjusted price to earnings multiple for both developed markets and emerging markets, as well as it gives you some multiples for some of the larger global equity markets in the world. the thing you first note is that developed markets are trading at a premium to historical median, whereas emerging markets are trading at a discount. But more importantly, developed markets have always traded at a premium, and that premium is a little over 50%. But right now, that premium is kind of widened to 90%, which we think is a significant margin. So you can see in the valuation that there's high degree of pessimism built in there by investors. And I think the lower valuations are only magnified when you look at a market like China, where multiples are now below 10 times. So it's fairly extreme. So though we see longer term opportunities in emerging markets, there are two important caveats that we want to highlight in the next slide. We would want to advise that taking an active approach rather than a passive approach is what we would kind of look to doing. Historically, emerging markets have proven to be less efficient than developed markets, and active managers have a greater ability to generate returns well above broad benchmarks. In fact, we've observed some value-oriented managers that have generated excellent returns in emerging markets, despite the fact that the returns have been fairly modest over the last decade for traditional broad benchmarks. The second caveat is that we would screen for investment managers with really strong risk management practices relating to sustainable practices on the environment, social, and most importantly, governance issues. I think the risks of investing in companies that are linked to state-owned enterprises or vulnerable to having unfriendly shareholder practices are, I think, greater in emerging markets. Hence why we think active management is so important when investing in developing economies. While we certainly agree that there's risks here, investing in emerging markets is not for the faint at heart. We do think that in the current state, given the points that we've highlighted, valuations, growth opportunities, it does provide investors with an important a reflection point that should not be ignored. We hope the topics today helped shed some light on considerations for your portfolio, and now I'll now pass it back to Kathleen for questions.
Terrific. If I could ask Krista and Frank, and we'll turn on our video here, and I'm going to just stop sharing here and see if we have any questions coming from everybody here. So yes, so let me see here. I want to start with the first question. Given that there, is still a possibility of a recession, what are some of the key indicators you're watching to adjust your clients' investment strategies?
And I think because we're thinking central banks are going to be data dependent, we do want to keep an eye on the direction of inflation. So if inflation proves to be stickier, particularly if the labor market continues to be stronger, those kinds of things may signal a more gradual approach to reducing rates, which may impact some of the sentiment in the market and the direction of markets. So I would say that economic data is one of the most important things. We're obviously watching those other risks, which sometimes are hard to absorb in the portfolio. Now, we want to have our portfolios set up to do well if things do well, but also to protect if things are tougher. So hopefully we don't need to really change course rapidly, but really looking at that economic data and inflation and how sticky it is probably the first thing we're looking at. Would you agree, Frank? Or?
Yeah, I would agree. I mean, obviously, critical to all this is the consumer. I mean, it's a big part of output. The consumers have shown a great deal of resilience. They've been able to continue to spend and not be totally. They haven't stopped consumption despite the higher rates, and that's important to see that they continue to kind of drive higher retail sales. The spending levels are not are still positive, and we're not seeing any pockets of concern about the delinquencies that get much worse than they are right now.
Oh, no,
absolutely.
Terrific. Well, I have another question here, and it makes sense since we're talking about emerging markets. Wanted to know, how would an investor safely access the India equity market if they were interested?
Well, I mean, the Indian market it's small. Like it's difficult to access. I think it was one of the points that we discussed in our last webinar. It's a market that's difficult to access for most investors because there's not a lot of Canadian-based investment managers that manage that asset class by itself. In many cases, you would have to locate, find, and select someone that is based in India, which is challenging even for us as professional investors. We have to do a lot of hard work to identify and find these investment managers. I think obviously there's ways to do it passively. There's exchange traded funds that have direct exposure to that country, but that comes with some pluses and minuses, as I highlighted. They're not some of those vehicles are not as diversified as we would hope. They don't provide you with exposure to perhaps some of the companies you would be interested in, the companies that are moving from small, mid to large because they're experiencing that growth. And also there's not the level of governance and risk management that's involved in some of those ETFs. So that's why, it's a longer route to manage them actively and identifying managers, but that's what we do, and that's what we try to identify. It is a challenge, but there are managers that we've identified that are able to provide that exposure.
Yeah, I think the emerging markets manager that we have right now in our global fund is based out of the UK, but does do direct investment in China and other countries in the emerging markets. So we have that manager addressing things now, and we have been looking at a series of Indian managers to see if we can allocate some capital there on behalf of clients through the fund.
Okay, well that's good to know, and hopefully that answered that question. I have another one here coming in, asking, would the outcome of the 2024 U.S. election have an impact on the return of the U.S. equities?
Yeah, it's interesting. There's been a lot written about what are the impact of elections, because on the face of things, you would say, if will the party that is successful, or the party that gains success in the House and in the Senate, will they have constraints on spending, or will there be more spending, which affects fiscal stimulus? What will they do in taxation, et cetera? But in reality, when you look at the numbers, it hasn't had a huge impact on returns. So I think in a year of an election, both parties will be trying to have a positive backdrop for the election. So I think you likely not see a lot of negativity right now. You could say, on the other hand, is there going to be a party that comes in and stops spending? Could that be negative? Are they going to incent things with taxation? But I think it's a little bit more neutral. The main thing you want to watch out for is volatility with, if there are extreme opinions, and also whether there's going to be gridlock, which we've seen in terms of things like the U.S. debt ceiling. So I think keeping an eye on it, but I don't think it'll be the main driver of returns in the U.S. equity section. Would you agree, Frank?
Yeah, I agree. I mean, I think the paper from AQR details what are the key drivers, and typically over long periods of time, those are the key drivers: earning growth, multiple expansion, dividends, and obviously cash.
Yeah, so elections can be noise on top more than other things.
No, for sure. And there's lots of noise, as we all can agree. We have two questions that seem to be related. So one of them, and I'll let Frank maybe take a chance at this one. They're asking about the Magnificent Seven stocks, and if they will continue to be dominant source of returns in the U.S. markets, and if so, what do you do? And then somebody else is asking about, since they've had that big run up, should they be, reallocating funds out of that into, things like healthcare or grocery because of that, and taking a little bit of their profits? Those are a couple of questions that are related.
Well, those companies have done fabulously well. They're well-run companies. I think the issue that we have, and I think other investors have, is valuation. That's where we were just questioning whether that valuation is justifiable relative to growth. I mean, our general view is that the growth will continue to be there, but if it decelerates a little bit, maybe people will have a second look at valuation, and the valuation might cause that to kind of hinder returns. So our view is, yes, we want to have exposure to those companies because we really think they're great companies. with global operations, with a lot of positive growth drivers. But we kind of would want to kind of manage that the position, not to make it an overwhelming part of the portfolio. So that's the message we would have. And yes, we would definitely, if there is an over concentration in those names, we would look at, diversifying into different parts of the market, smaller caps, some other companies that are maybe not as large, however, far more attractive valuations. So we would want to make sure that the portfolio is diversified and not too tied to those names, which are looking rich from a valuation perspective.
Right. And there's this next question. I think it ties in a little bit to some of this and your discussion earlier on diversification. But the next question is, should we invest more on the U.S. equities instead of Canadian equities? So I don't know, Krista, if you want to maybe take a shot
I
at
think
that one.
I think you want to have that diversification we talked about across the portfolio. So there's still, I think the U.S. economy is strong, and that's still going to benefit. And that's sort of to the points that Frank was making. There's still strength in that market, and there's still really good companies that we can access there. So we don't want to be absent from that. But I think also seeing some broadening of returns to other sectors and other things would allow us to look at other markets. Canada's always very particular because we have so much in terms of energy and financials. It's a very different profile to markets than some. So, for financials, you've got the combination. You've got, if there's going to be delinquencies or concerns, that could be hard. But on the other hand, it's interest rate sensitive. So with rates coming down, that should be positive. Energy is really, low. You could say it's a great bargain right now, but I think there's also some pressure on that, and that is impacted by recession. So I don't think we're making a big bet on Canada. We're probably still a little bit bigger on our US allocations overall. And then we have, some Canadian stocks, as well as having some international stocks. So we're trying to be really diversified. And that, it's also impacted by where our clients spend their money in terms of where we want to have currency risk, et cetera. But so I think not absent either of those, but I think being aware of that broadening out. So we're looking at some US and then having still some other good names in other geographies as well.
Yeah, no, that makes a lot of sense and really ties back to both of your discussions today. We're running a little bit out of time as we end, but I thought I'd turn it back to both of you just for your final comments and before we wrap things up. Maybe Frank, you can start, and then Krista can end us off.
Sure.
No, I mean, just from my perspective, I think my comments are more longer term in nature. And it's just there's risks in the market, and people need to kind of completely be aware of them. I think the U.S. market's fantastic, but you need to kind of put those future return prospects into context. So you don't want to be too concentrated. So you want to maintain diversity. And there's opportunities in markets that no one really likes these days, which is emerging markets, which for a longer term investor, people should consider as a way to kind of diversify out of North America.
Sure. No, and Krista,
yeah, and I think it's I know we're talking about a quarter and a year. It sounds like we're being very short term, but I think that's just being aware of the context. So it was really nice to see 2023 end on a positive note after having had a difficult 2022. So that's nice to see in portfolios, nice to see that impact of 2022 tailing off because of the positive 2023. And I think there are a lot of positive things, like inflation moving in the right direction. Interest rates will start coming off. Earnings per share are still likely going to be increasing. Consumer still seems to be strong. So all of those positives, but we still need to be aware of those risks. So we would really say we're cautiously optimistic at this stage. I wouldn't be surprised if we see a pullback. Markets keep roaring ahead like they did on Friday, and futures were up this morning. But I think, it wouldn't be surprising to see a bit of a pullback. We think that would be normal. I think rates will start coming off the second half of the year. And really, we want to just have a well-diversified, long-term approach to your portfolios. Right. And then that'll help us both if markets are strong, but also if recession risks are there. So really trying to moderate expectations and have a good long-term view is what we're looking at. And we'll certainly be looking forward to speaking with you about your portfolios.
Yeah, no, very insightful. I want to really thank both of you today, Krista, for your And thanks for both of your excellent discussion and points on what to consider and how to plan ahead for the upcoming months ahead to manage our expectations. And I also like everybody, thank them for attending. I want to let just a few housekeeping points here is just to let everybody know that you will be receiving an email after our presentation, and it will give you access to the recording that you can watch or share with somebody else if you think they might be interested. And if you do have any other questions, of course, reach out to your advisors. If you're a client of Kerr, reach out to your advisor here at Kerr. We'd be happy to answer any of your questions. Thanks so much.
Thank you very much, everybody.
All right. See you later.
Thank you.
Thank you.
Bye.